Corporate tax avoidance is commonly defined as the use of legal strategies that exploit gaps and loopholes in tax regulations to reduce tax liabilities. The topic has attracted growing attention from academics, policymakers, and the public. This increased scrutiny follows several high-profile tax cases that highlighted the scale of profit shifting and the erosion of national tax bases. From a firm's perspective, taxation is a major operating cost, accounting for nearly 1/3 of pre-tax income on average. Such a substantial financial burden creates strong incentives for firms to engage in sophisticated tax planning practices in order to minimize tax payments. From a societal standpoint, corporate tax avoidance is widely viewed as socially irresponsible and ethically problematic, as tax revenues are essential for financing public goods, social welfare, and economic development. In this context, corporate social responsibility provides a relevant framework for understanding firms' tax behavior. It emphasizes firms' obligations toward a broad set of stakeholders and promotes ethical conduct beyond mere legal compliance. If tax payments are viewed as a contribution to society, firms with stronger CSR commitments may be less inclined to engage in aggressive tax avoidance strategies that conflict with societal norms. Accordingly, we wondered whether corporate social responsibility reduces tax avoidance and how this effect varies depending on the disciplinary roles of debt, corporate governance, and family ownership.
To answer this question, we analyzed a sample of French-listed companies from 2005 to 2017. Surprisingly, we find that firms engaging in CSR are more likely to engage in tax avoidance practices. This suggests that firms undertake CSR activities as one means of hedging risky tax positions and to appear more environmentally friendly. However, strong monitoring mechanisms such as higher levels of debt and corporate governance reduce this effect, suggesting that well-monitored CSR activities reduce tax avoidance practices. We also find that family-owned firms behave differently. When these firms invest in CSR, they are less likely to avoid taxes for socioeconomic wealth purposes. Family firms don't pursue financial objectives, but rather than social issues, and are then more likely to pay their taxes because they are willing to preserve their family business for future generations. From a managerial perspective, our findings suggest that managers should strengthen internal governance structures to ensure that the firm's tax strategy is aligned with social and environmental commitments. By doing so, firms can reduce reputational costs, enhance stakeholder trust, and reinforce the credibility of their sustainability strategies. From a policy perspective, our results provide useful insights for French regulators when preparing future tax regimes. Greater transparency and clear rules can help to build a fair tax system that can tackle tax evasion and aggressive tax avoidance.